You were up there talking a little bit about not a liquidity crisis, but a little liquidity concern, I think you said you had. Tell me a little bit about your thesis there.
So the Fed has been reducing the size of its balance sheet, and that is the reserves at banks. There's way more reserves in the banking system than is necessary. So they've done what's called quantitative tightening to start to reduce it. Where's the optimal level? And if we're honest with ourselves, we don't know.
I wanted to talk to you briefly about some of what you were talking about on stage here at the Astoria Macro Summit. You guys were just up there talking about the bond market, you're talking about interest rates, talking about the Fed race. Break this down for a normal person who doesn't follow fixed income markets like a hawk every single day. It feels like in this government shutdown window, it's really difficult for investors to know what to trust. What are you looking at in this window when we've got not enough information?
Well, it is difficult because the typical information that we would get, which tends to be government reports, are not being released.
Right.
That doesn't mean there isn't no information out there. There are private sector businesses that will put out data on what they're seeing. A great example is car sales. That the auto companies will report the number of car sales every month. We've got private sector people like Challenger Gray and Christmas that will report the number of layoffs that we see every month. We have surveys like the University of Michigan and the National Federation of Independent Businesses, NFIB, which will do surveys on how businesses and how the consumer are viewing the state of the labor market, the state of inflation. So there is data out there. But now that I've said that, most people have become accustomed to a certain data set and a certain flow of data that they've put into their process to try and understand the economy.
Or even models, right?
Right.
People run models where CPI is an input.
Right.
If that's now delayed 2 weeks.
By the way, who runs models is the Federal Reserve. Their model is called US1 that they put all this data into. Well, now this data is not being released. That doesn't mean, could they in theory, pivot their model to this new data? Sure, but not in like one day. You'd have to collect the data, you'd have to analyze it, you'd have to redo it all. And then the problem is, and then the fear is Friday the government shutdown's over, and then you start getting all the data. So it's not that we don't know, but so much of this is quantitatively driven by models and everything that we've been kind of thrown for a loop. So it's not that we're blind to what the economy is doing. It's just we're not getting it in the regular format we're comfortable
with. So should we think about this as kind of an opening up of the expectations or error window around our knowledge of what's going on? Like
Sure.
3 weeks ago, we had this much certainty, and now we have this much certainty.
Sure, and people are using certain inputs with certainty. And I'll give you an example. The Federal Reserve Bank of Chicago put out a new index, which has a model. It's a model, and it predicts where the unemployment rate is going to be for the next couple of months, and it's got it going up. Okay, they just released this in August. We haven't seen it operate in real time.
Right, we don't have years of history to be able to be like, oh, this tracks ADP.
Right, because the problem with a model is if I put together a model based on history, I could fit it very well. That doesn't mean from this moment forward that the history is going to work.
Right, like any back test.
But the thing about this thing is I hear people talking about this with certainty. Well, of course, the unemployment rate's going up. I'm like, it's not being released. Well, the Chicago Fed says that it's going up. Well, it's a model that was just released 30 days ago or 40 days ago. Maybe it's right, maybe it's not right. So that's what I mean by, you're right, opening up the uncertainty window. We're starting to trust things that we normally wouldn't have, but in the lack of data, we are starting to trust it.
It feels like this cloud of unknowing hits us at a time that's particularly not great because we have major shifts we know are going in the economy. We just changed the interest rate cycle. We have multiple wars going on. We have lots of big things happening. It seems like a particularly poor time to have bad data. When you're looking at portfolios, when you're talking to your clients and people who you work with, how are you helping them position through this? Is it a stay the course kind of modality, or are you actually repositioning because of this increased uncertainty?
I'm not repositioning because of the uncertainty, but I am trying to find alternate ways to look at the way that the world works. The first place we would start is probably a heavier reliance on financial market data. What are corporate spreads doing? What is the stock market's valuation doing? What sectors in the market are going up versus going down? And maybe leaning a little heavier on that. Maybe that's right. maybe that's wrong. The other one is the myriad of alternative data that we've seen as well. So trying to understand that, but your larger point, you're right, because what's happening right now, we've got wars ending, we've got, as I've pointed out, Trump has announced 14 separate changes to tariffs in the month of October, and we've got the 100% tariffs for China coming November 1st. So I didn't even count that because that's next month's number.
And we don't even know.
Right. Yeah, we don't even know because they're going to meet. He's going to meet with Chairman Xi in a couple of weeks. Maybe that happens. Maybe that doesn't happen. It'd be nice to know how this is impacting the economy, but it's been very difficult to try and get through it. But so it's something that maybe in the long run, we in the private sector and everybody else will start to put a little bit more private sector data as opposed to government data into their models. So in the future, when this happens, well, we've got a certain part of it that feeds on some of this other data as well. So hopefully that's what we'll see from the economy and from the markets moving forward.
Okay, one last thing before I let you go, because I know we got a lot going on today. You were up there talking a little bit about not a liquidity crisis, but a little liquidity concern, I think you said you had about the market, particularly like at the core of liquidity, banks moving money around, settlement payment, that kind of stuff. Tell me a little bit about your thesis there about why you think we have a little bit of a hidden liquidity crisis.
So the Fed has been reducing the size of its balance sheet, and that is the reserves at banks. And the reserves at banks give them the ability to make new loans because they have enough capital enough reserves, to make new loans, to meet other obligations on settlement of transactions, and maybe even have a cushion in case there's some kind of a write-down. They being the Fed knew 2 or 3 years ago, there's way more reserves in the banking system than is necessary. So they've done what's called quantitative tightening to start to reduce it. Okay, fine. Where's the optimal level? And if we're honest with ourselves, we don't know. Because this is it's called an ample reserve system. It's never been done before in the US. So we're kind of guessing.
Right.
And so
the idea is to right size the reserve, right? So not just have a giant pool and let whatever happens.
Right, because what happens if you have a giant pool of reserves is you could unleash the banks to doing lending and transactions when you don't want them.
Right.
Because maybe the economy's starting to heat up and you're starting to get inflation and you'd like things to be a little bit moderate and they could just be handing out loans left and right. And the like. And that's the whole point of a fractional reserve system with a regulator like the Federal Reserve is to try and regulate that. So they've been pulling that back. And we don't know where that level is. And what we've seen is measures of liquidity in the market, like the repo rate, the repurchase rate. Banks that have excess cash, there's 4,000 of banks, can lend it to banks that are a little bit short cash. And that's what you do in the repo market. And all of a sudden, we're starting to see these rates move up, meaning that the demand for cash from other banks is up, but the supply has been coming down, and maybe we're kind of either at equilibrium or a little bit beyond the equilibrium rate.
So what's the policy response then? If we overshoot and now all of a sudden we're like, oh my gosh, you can get more in repo than you can get in T-bills, right? If it just goes nuts,
right?
Then what's the right answer? Is it a quick policy response from the Fed? Is it cutting off quantitative tightening and going back to easing? Like how does that unwind when we hit that barrier?
Well, keep in mind too that again I said a fractional banking system, and now. What that means is that banks are highly leveraged, right? They have a little bit of capital, and they might have $1 trillion of loans, and $1 trillion of capital and $10 trillion of loans. So they're very levered. So when you look at these rates moving up, you might say, well, these are kind of small numbers, right? They've moved from 4.02 to 4.2. That's 18 basis points, 18.18%. That's not a big number if you're a retail investor thinking about
on $10 trillion.
Yeah, but on a $1 trillion equity base, that is a big deal. That is a big deal. And we don't know that it stopped, right? It could continue to move up over the next few weeks. So that's definitely why it matters a lot for the banks. But the policy response is the Fed will probably end quantitative tightening. That's the reduction of the balance sheet, the removal of excess liquidity out of the system. They have a meeting from when we're recording the next following week, in about 10 days. They're going to have a meeting. I suspect they'll announce that they're going to end quantitative tightening. It may not end it the next day.
Wind it down over the year.
Yeah, wind it down, over a couple of months or something like that. But there's an old adage in the bond market that the Fed, when they start hiking, they don't know where they need to go. And so the Fed keeps hiking until something breaks. And it's like the 2025 version of this is the Fed keeps QEing until something breaks.
Right.
And that's the concern, is that no, they haven't broken anything, but there are signs that things are getting bent, and if you bend them too much, they could break. So that's why I called it a worry, a concern, not a full-blown crisis. And we'll have to see if the Fed does end QT and they do wind it down. Then the next question we'll have to ask, which we don't know yet, is have they already gone too far?
Well, and when we took
They pulled out too much liquidity.
If we look at other corners of the bond market, I'm thinking specifically things like private credit,
right?
Where you would expect that to be where you start seeing some of the defaults initially, and we have seen a couple of hiccups in the last couple of weeks. Are you particularly concerned there? Do you think that private credit is a canary in a coal mine if we get these calibrations wrong?
Yeah, they are. As I've said, the banks hand out trillions of dollars of loans. And the banks are in a tough spot because we go crazy when they hand out loans that go bad because we worry that there's going to be a financial crisis. Right. But then if they hand out loans that never go bad, we go crazy because
they don't earn enough money.
Right. Well, they're only giving. Yeah. Well, not just that, but they're only giving loans to people that don't need them.
Right.
Because those are the ones that can pay them back. So we want this happy medium where they are being a little bit of a risk taker, but never take a loss. Well, you can't have that. So the point is they always have write-downs. They always have loan losses. But most of the time it doesn't matter. Then it does matter. And I would argue it's more of an environmental thing that when the loan losses that we've seen being announced start to bother the market, that it might be more about what kind of environment are we in that it's bothering the market as opposed to that they're loan losses. And I would argue this lack of liquidity, this pullback on liquidity is bothering the market because, and that's why all these announcements now matter. Whereas 3 months ago, if a bank announced a loan loss, and they all nobody cared.
And now all of a sudden we've got headlines about cockroaches all over the street.
Right.
Bad loans everywhere.
Right. And as far as private credit goes, the concern that everybody has with private credit, the little metaphor that Jamie Dimon gave, and I think he's right, is every day at JP Morgan's offices, they make space for over 1,000 regulators who go to a JP Morgan office who just regulate JP Morgan because of Dodd-Frank and everything else. Okay, if you go to Apollo's office or Blue Owl's office, the big private credit providers, how many office desks are they making for regulators to regulate what they're doing? Zero.
Yeah.
And so Dimon's argument was either put Dodd-Frank on them or relieve me of it.
Right.
But so private credit has been more of like a regulatory arbitrage. We can go into the best credits and say, we can underprice JP Morgan because we've got a lower cost because we don't have all these bureaucracies that we have to deal with. The concern that everybody has with private credit is all the best deals, all the best credits already are done.
Right.
Now we have to start reaching for the next riskier.
Right.
And because there's no regulation we don't know. And that's why everybody gets worried about it. But that's not a new story. It's now become a story now, and I would think it's because of the lack of liquidity.
Yeah. All right, Jim, so much.
Thank you.
Thanks very much. Cheers.